Good afternoon, everyone. Thank you for joining for this webinar. We'll give people a few minutes to join and we'll kick right off. All the panelists are ready and eager to share their journey of this intervention and learnings with you. Hello again, everyone who's attending. We're just going to give one more minute and then kick off. I'm Sita Shah, the Senior Affordable Housing Specialist at FSD Kenya. And I'm joined by panelists, one with me and others in 4 different locations, which is the wonder that we've come to after COVID, to enable such diverse footprints to enable the learning. The recording of the webinar is being done, and very shortly, we will be sharing a full report on the work done. This webinar is really to give you the highlights of the work undertaken and why it is so significant to shift the housing value chains. Okay, so I think we should kick off. As I said, I'm Sita Shah from FSD Kenya. I'm joined by 3 interesting organizations. The first is NACHU, the National Union for Housing Cooperatives, which since 1987 has been working to create housing cooperatives. And Stanley Ndungu, the finance director at NACHU, will be speaking shortly on the volume of the housing cooperatives that they've enabled and the land they've been able to buy. This shows that when cooperative members have a goal, like they had a goal with buying land, they were able to put together their savings to enable the goal. Unfortunately, after buying the land, there has been challenges in accessing finance to construct housing. And this work stream is specifically trying to unlock that. But it's not starting directly at the construction finance. It is looking at a very structured approach on how can we look at the joint potential and payment ability of the housing cooperative members and use that in a structured way to unlock the construction financing. So with NACHU then is a very interesting organization called Placemakers. It's a registered joint venture that was formed in 2021 between NACHU and housing professionals who have been in the landscape and have been working in different organizations like REAL for over 3 decades. So it's bringing together the power of housing finance knowledge and the aggregation of cooperatives to enable structuring such products, doing the advisory work to help unlock the financing. And then Stanley will introduce Pngme, a data infrastructure platform that was onboarded for the second part of this work stream. So what we're going to go through is, just a second, what we're going to go through is understanding the cooperatives, the challenge, the guarantee model, the realities and the pilot, and the plan for national scale. And before I give it to Stanley, what I'd really like to share are 2 learnings that sat with me when I joined FSD Kenya. I came as a housing professional to a non-sector agnostic organization. FSD Kenya works in many sectors from agriculture to health finance. And the first learning I had was that households, which is very clearly shown in FinAccess, which is a survey we run every 2 years with Kenya National Bureau of Statistics and Central Bank of Kenya. This was my very first learning. Households prioritize the following: food, education, health, and then housing. As a housing professional, that has to lift your mindset, because you can't just expect what households are going to pay. You have to show that when there's a limited wallet, how are they going to split the limited wallet amongst their priorities? And this is why housing quality is so compromised, because the households have no other choice but to prioritize the other priorities. With that in mind, we learned that many households are not housing ready. Maybe there will be pre-housing. How do you find out which households you should then put on the housing ladder? Maybe not all households are ready for the housing journey, and there can be other solutions like dignified rental. The second learning I really understood at FSD was the power of credit information sharing, which, while all organizations are working to improve that in Kenya, and FSD has played a large role, it will still take a lot of time for our credit information sharing to be at the level needed to understand the household affordability, indebtedness, etc. So with that big macroeconomic problem of not knowing how indebted a household is, the structure and the innovation that Placemakers is proposing here helps you really tangibly understand the affordability of the household, because they're providing a process for the households to get onto the savings ladder. And the households will want to be on the savings ladder because they can see the house unit itself that they are aspiring to. So with those remarks, I'd like to hand it over to Stanley, who is the Finance Director at NACHU. Thank you so much for joining our webinar.
Thank you, Sita, for that introduction, and welcome you all for this important webinar. As Sita has ably introduced, I'm Stanley Ndungu. I'm the head of finance in NACHU, and we have a working relationship with a UK company called Ubuntu, where we were able to form a JV company called Placemakers, and we are trying to use the cooperative model to see how we can be able to go about the affordable housing. The problem that is at hand at the moment is that the demand is there for affordable housing. But now the challenge that we have is actually to verify and to understand that demand, which now gave us now to the study that we did, which will be the focus actually of this webinar. But before we go to the details of the webinar, I would like to put you through key realities of the cooperative sector in Kenya to understand the strategic position the cooperative sits in the delivery of affordable housing in Kenya. Currently, we have about 2,500 housing and investment cooperatives in Kenya. And the number of, the total number membership of the cooperatives is about 14 million. Out of that, if we go basic data, which out of that, which are in the urban, which are in the rural, we just take the percentage of the urban population in Kenya, which is about that 3%. It means we have about 4.6 million people in the urban areas. And again, if you go down again to it, how many of these people own houses? You realize that about 3.3 million of those people in the cooperative sector, about 3.3 million, that is 72%, do not own a home. That actually is actually demonstrated by the loans that the regulated circle disbursed in 2024, because out of the portfolio, the largest portion of their portfolio, about 25%, that is about USD 1 billion, actually went to housing. So which tells you the relevance of the cooperative sector in housing. And that's why we are so keen to promote the cooperative movement and the cooperative sector, because we believe that we can be, the demand has already been aggregated. And that's why we want now to go to the next stage of trying to verify that demand and to demonstrate that demand. Now, in terms of NACHU, we have about 250,000 members from a total number of 902 cooperatives. Sorry. And to understand the nature of these housing cooperatives, what are they? What form do they take? One, some are land-owning development cooperatives. They have land, and their interest is to do development. So we have quite a number of those. Others are mature cooperatives with a large number of housing beneficiaries. But now the challenge is, how can we be able to quantify those beneficiaries? How can we be able to say that those beneficiaries are housing ready? It is the answer to this webinar. Others are investment-oriented cooperatives. The members want to get return from real estate related activities. So we still have quite a number of those. The others are early stage or low income savings cooperative. They are in the early stages. They have not defined their objectives. They are yet to define what they want. So what they are doing, they're just saving. And as they travel the journey of house ownership, they will go on increasing their savings once their objectives are clear. The others are individual saving housing cooperatives. They are just there because of the structures. So they have still not defined what they want, but since the structures are there, they just join and start savings. Then we have the purpose-driven cooperatives, specialized, that have been formed specifically to do a certain activity. Once that activity is done, they will just dissolve. Like, for example, they may want to resettle their members. That is a single purpose activity. Once that is done, they will just dissolve. And what is the advantage of housing cooperative model? One, and the biggest advantage of the housing cooperative model, is that it is member-based and member-controlled. So that gives a highly trusted, tightly knit structure that members can trust. And it also brings about accountability and also the governance level, because it is members controlled. And then we have the other key advantages of these housing cooperatives is that their objectives is aligned. So we don't have conflict of missions. Every member has joined because of a specific goal. So everything is aligned. And also, many cooperatives at the moment, they have ready land for development. Actually, a recent survey that we did, we have 300 hectares ready for development of about 15,000 units or so. And that is actually our focus, to be able to arrange those housing ready, or the land which is ready for development, to be able to arrange the waiting list and be able to verify the waiting list. The other advantage is that there is an efficient network for program delivery. So the structure is there, the supervision is there, and the governance structures are there. So these are already structures to go to be able to deliver affordable housing. So then, out of that, the advantage, what are the opportunities that we have? We realize that if we have a process where we can have a standardized onboarding, a criteria that we can be able to onboard these customers, to have them so that we understand, we can be able to verify them, then we can be able to walk the journey of house ownership. Then the second one is that how can we be able to improve efficiency by any digital connections or any digital enhancement to the operations of the housing cooperatives. And then out of that, how can we have a structured way that we can be able to define how these, how the members can be able to travel their housing journey? Which are the members? Can we be able to say which are the members who are housing ready? And then for those ones who are not housing ready, what are the interventions that we can do? What are the other innovations that we can be able to introduce, like flexible repayments? So those are the opportunities that we have if we can be able to have a verifiable system that can be able to onboard our members and can be able to analyze our members. So in this exercise, NACHU was to mobilize and to enroll. We targeted about out of our portfolio of about 900 cooperatives. We were able to target about that 29 cooperatives. That was actually our role to be able to mobilize those cooperatives, to convene onboarding session, and to support the members' engagement. And we'll be able to highlight to you how that result was. Of course, NACHU being the union for the housing cooperatives, we were able to provide the credibility and trust, because as you will see later in the other panelists, this system required a lot of information sharing, and therefore we needed to be the backbone to provide the credibility and trust. We also had to train to do a TOT for the cooperative leaders to be the champions, to be able to onboard their members. And also we also had systems for if there is any issue that is coming up during the process, we also had a system to support that. And also we also provided linkages with all the stakeholders. So we provided that governance support that actually was required in the whole process. So why all these exercises? The big issue in the room is actually the housing challenge that we have. As you all know, in Kenya, we have about 2 million housing deficit. Out of the 2 million plus that we need to house, 80% actually cannot afford the supply that is there. And that is actually where our target is. And that is actually being reflected by the current mortgage penetration, which, as you know, is actually quite low. So So the main objective of this study was actually how can we be able to bring other innovations towards house ownership? How can we bring about rent-to-own models towards ownership? Because what we are saying is that the issue is not demand. The issue is about how to understand that demand. How do we have a credible and a verified optic that will give developers and financiers confidence to build? That is actually the issue on the table. How can we be able to provide an end-to-end solution? Because what we are saying is that development capital is there, but how to de-risk that development capital is the issue. So we are coming in to provide a system that we can be able to create a waiting list. And not only a waiting list, but a waiting list that is verified, a waiting list that can be established. So, ladies and gentlemen, that waiting list can only be able to be established through an efficient digital infrastructure. And therefore now, we had to go to the next step of trying to understand what are the infrastructure that we have. What are the systems that we have? And that drove us to identify a digital infrastructure company called Pngme. So we were able to identify Pngme, and the reason why we were able to pick, why we were able to pick Pngme is that as you are going to realize, most of our target population is actually informal sector, about 66%, which means that their financial information is highly fragmented. You know, it has been a challenge to be able to verify informal sector. So we needed a system that has got quite a variety of data points that can be able to assess, or can be able to correct, or can be able to assemble, to integrate all the financial data points that can be able to be assembled. So that was possible through the digital infrastructure that Pngme has been able to create, because out of the data point that was necessary, Pngme was able to connect to almost 180 data points. That is a very rich financial environment that went far beyond even being able to understand the consumer behavior. You know, you see, the way you buy airtime, the way you do your shopping, it means a lot in your financial landscape. And it is very important, especially in the informal sector, to be able to understand quite a variety of that. So Pngme was able to demonstrate that. And also, we also had a limitation of time. We had about 12 to 16 weeks. And, you know, being able to get a system that can be able to program, to be able to understand, or to be able to integrate over 180 data points, that was incredible. And Pngme was able to demonstrate that they can be able to program that. But now the other most important aspect was about data protection and security, because this one required accessibility of quite a variety of customer information. You know, Pngme system is based on permission-driven process. And also, Pngme is currently working with 2 tier banks in Kenya, which means they have passed the regulatory test, which also gave us a bit of confidence. So we'll be able to, my next panelist will be able to give you the details of that study so that we are able to understand exactly how we are able to demonstrate how we can be able to de-risk development capital using a verified waiting list. So therefore, now I wish now to take this opportunity now to hand over to my next presenter, that is Joe, who will now take you through exactly the infrastructure of these waiting lists so that you're able to understand exactly what exactly we mean by this waiting list and what actually was what came out from this study that we did. So thank you so much.
Thank you, Stanley. Good afternoon, everybody. My name is Joe Deswardt. I'm a director at Placemakers. Placemakers is a...
Joe, could you speak up a bit?
Yeah, sure. Good afternoon, everybody. My name is Joe Deswardt. I'm one of the founder directors of Placemakers here based in Kenya. Placemakers is a joint company between Ubuntu in the UK and NACHU. What we focus on primarily is really trying to look at the entire value chain together with NACHU and others, and to really unlock the kind of rollout of more housing units and how to get more units delivered over a period of time. So what the slide that we're looking at now is showing us is that the market does not, in our experience, the market doesn't fail because households don't want housing, but it fails because today's demand signal is just too weak to finance against. So registration and expressions of interest do not equal readiness. Units are often priced above what target households can genuinely carry. The deposits come in a little bit too late or not at all. And any vacancy or payment risk with a sitting tenant or occupant sits almost entirely with the developer or the off-taker. So the result is a coordination failure between households waiting for supply of housing and developers that wait for credible offtake and financiers that wait for evidence that they can use to determine risk. So the purpose of this whole project and the work was to break that deadlock by converting relatively informal, weak data type of situation that we find ourselves in Kenya, with more informal interest into a more verified, auditable, deposit-backed demand situation that can be guaranteed. So what we then did is we brought together, obviously, a number of partners. During the process, like Stanley said, it was a very short process in time. We talked extensively and very helpfully with a number of people in the sector. I think NACHU have already introduced themselves, but NACHU really is a gateway to people and to be the people helping us to structure that waiting list. On the banking side, we had very, very good discussions with ABC Bank, with Shamaz Tsavani and his team, and also with Brian Mather and Silicon Enterprise in South Africa with their fantastic Chama platform product. which really can create a white label banking Charma wallet system that one can easily take your waiting list people and bring them in and keep them interested. And why this section of the banking and pre-housing savings phase is so important is because otherwise you end up with a static waiting list. And static waiting lists mean that the data was right when it was recorded, maybe, but very quickly that static waiting list can break down and become dated. And then on the scoring and profiling of people now pushed by NACHU on some kind of walleted bank-based system on a Charma platform, to then start looking at the kind of credit and behavior matching of these individuals. We looked at a number of different companies out there provide the service, but ultimately settled on Pngme, simply because Pngme has already got all the various data protection and other credibilities in place and already operational here in Kenya. And the advantage of Pngme as well is it's a live system. So it's not like you've done a credit assessment on somebody once. If people are actively using the wallet platform to save, to take small loans, to do something with, the Pngme will consistently monitor what's going on there and give us 24-hour a day ready updated information that gives us that client and household profile. In terms of property offtake, the chain there are many developers such as us, Placemakers, that find land. We battle our way through the planning systems. We deal with a very vicarious economy that we sit in. And we struggle with the reliability of materials and labor shortages, etc., and battle our way through to try and deliver innovative housing products that are really affordable. And for us, what is super important is if we can get an off-taker from day one. So the off-taker we talked to here was Empower. Empower is just in the process of settling into Kenya, but it's a Netherlands-based company that's doing some interesting, very, very interesting work on taking people off these kind of waiting lists and being able to turn them into daily rent to own type of profiles, flexible repayments, all the kind of stuff that no bank at the moment will offer anybody. I don't think there's a bank that will offer somebody a mortgage that's a daily repayment mortgage and will be okay if 1 month you pay double and the next month you pay nothing. That can take flexible payments and work like that. And so Empower has really worked that system, and we had very, very valuable interchanges with them. And so the whole idea is that at the end of the day, we produce a house and we match that house to a client. And so the waiting list is a matching process towards that. Next slide, please. So the solution here is a tenant housing waiting list, kind of guaranteed tenant housing waiting list. And the core proposition in one line is a structured waiting list plus a bounded guarantee that produce a very strong, that strengthens the offtake. So the waiting list gives us a verified deposit-ready household. The guarantee covers a very limited window of potential non-payments for, after the deposit has been depleted, somebody is not paying, the deposit's depleted, and then there's time to try and evict somebody or to try find a replacement person to take over. That period of time normally really is a massive risk hole that the banks and other financial institutions seem to be wary of. also the first 2-3 years after development has been off-taken, the off-taker has not necessarily at that point got their own sinking funds and provision funds suitably built up to be able to absorb, voids and non-payments. And so the idea of the guarantee is to sit for a very structured period of time. It's a very designed bound guarantee. It covers a limited period of time. And it gives, therefore, developers and financiers something that they can actually underwrite. So this is not about a subsidy, but subsidy kind of bad economics. It's really about making real demand visible, disciplined, and bankable. And that's why we believe that this can unlock debt and equity to developers like us. Because if we have an off-taker that's going to take 100% of these units, and that off-taker is going to be successful because there is a guarantee tied to the occupants that they take and their ability to know that they can populate and occupy these units is fully worked out from day one. We know that we get the houses off-taken, occupied, and for a period of time, payments guaranteed, which means that from the bank's point of view, the off-taker will be good for the money, and hopefully one can turn that off-take more into something that looks like collateral. Next slide. So if you look at the decision chain here, one of the strongest features of the model is that it is not opaque. The process is designed to be traceable from first contact right through to final decision. So we start with identity. We get consent from the household. We look at the household formation. We look at their cooperative affiliation. We get a report from the cooperative, how long this person has been a member, what's their behaviour, how good are they, have you ever visited them in their house, do you know their family, etc., etc. So the cooperative sector itself has a bunch of information that, if packaged correctly, is really powerful. And then also to look at the affordability inputs. We saw in the earlier slides that 80% of people are pre-housing. They cannot afford any version of housing except maybe renting from a slum landlord. We then try to bring the digital transaction data and this cooperative-led held information together. And that now gives us, that feeds now the scoring, the ranking, the deposit verification, and the matching to units that are being developed or in the pipeline of being developed. And later also helps with claims monitoring. Should somebody not repay and there's a claim against the guarantee, how can we monitor this? How can we make sure we understand why this is happening? We can fix the system backwards. The important point here is governance. So every major decision point can be evidenced, audited, and challenged. And that matters for fairness to the household, but also matters commercially, because financiers and off-takers will only trust the system if the allocation and the guarantee process is disciplined and transparent. Next slide, please.
Joe, I just want to do a time check. It's 3:40, so maybe just take the speed a touch faster, not so fast that we're not able to explain it, but just a touch. Thank you.
Okay, so let me just skip this slide then. What we ultimately, that's just more of the process there, somewhat repetitive. So we go to this slide. So effectively what one ends up with is a tiered attribution funnel that starts with potentially the entire population, but eventually breaks it down to people that are now market ready. And step 8, which is not shown here because that's ultimately the success of the waiting list, is when somebody's moved through all these 7 tiers into tier 8, where they now are, they've been allocated a house and they are able to move on. So funnel is very important because it makes the economics very honest. And we should expect a large population at the top end and a much smaller pool of market-ready households that fall out the bottom end. So this is not failure, because in the past this would have been seen as failure. But this is now creating a system that's doing its filtering job really quite properly. And then we can really help people to show that the interest is really ready. And it can also help developers not to overbuild, financiers to misprice the risk, and households are not set up to fail. And the funnel also shows us the conversion between each of these levels, and it can help develop a relationship with people that are pre-housing and not yet market ready to understand where they are on this journey towards home ownership and what they need to do to improve their own matchability and their own readiness. So go to the next slide. This one too, we can basically skip. It's just to show you kind of roughly the market today for a studio bedsit. You know, you're looking at unit sizes 15 square meters to 25 square meters. And the unit sales price is about, it's roughly about 100 million, so 0.99 million per unit. One beds are typically between 25 to 30 square meters, and the cost of the price range is 60 to 90, etc., etc. So there's metrics there that we have followed through on. And so we know what the units cost. If we then look at the deposit requirements, now, sorry, the slide is difficult to read on this basis. The fonts are small. But, you know, what we're saying is we worked with some cooperatives here. One cooperative we worked with, every single person in that cooperative would be considered as pre-housing. The monthly income and ability to pay towards housing was too small to afford anything. But what you can do with those people is start a deposit accumulating process. So even if it takes you 4 or 5 years to build up a massive deposit, a deposit that's 30, 40%, so that the residual that's now left over, you can now afford it on a rent-to-own basis. At least you are already on a housing journey. And maybe that deposit that you're busy accumulating, maybe one can use that money and invest it and make it grow more. And maybe even if on the Chama system, we can give people small loans and things to help them build their income, help them to become, to increase their income, so their own affordability starts to work. So at the moment, not discard 80% of the population that cannot afford a house, but actually start that journey earlier on with people. Because if you can put 80% deposit down, you can afford over 20 years or 15 years on a rent-to-own system. You only have to pay very little every month. But it might take you 10 years to get to that deposit. So not start the process now, start it early. Now, clearly, there's a kind of nice green zone here in the middle, where the deposits are about 13 to 17%, and that is where you really want people to go into. And so, you know, deposits play a very critical role there. And then in terms of what this slide really tries to show is just the commercial logic. The household enters into a rent-to-own pathway and makes the required payments. And if there's stress or interruption, the deposit takes the first loss. The guarantee only comes in after the deposit buffer is exhausted, and even then, only for a defined limited period of time that gives the landlord the ability to make every effort to get the tenant back on track, or to swap the tenant out for somebody else on the waiting list. So again, the waiting list is very powerful because it provides a ready source of potential replacement people for where people really cannot master the housing situation. So guarantee doesn't carry the whole entire credit risk for the household. It's covering a very narrow bridge of deposit exhaustion and to the rapid reletting or stabilization of the unit itself. And so that's why the design discipline matters so much. And get the model, for the model to scale, it must be monitored like a real operating business and not treated as a once-off pilot. So the dashboard needs to track the onboarding volumes. How are we making out with onboarding more people? The conversion from tier to tier to tier, the slow way people are building and saving up their deposits, matching speed for units becoming available to match that, to be sure that the people are occupancy ready when the units come available. To look at also the arrears, the claim frequencies, how many times is there a claim against this guarantee? What is the claim duration? How many months does the guarantee have to pay out for? And the time it takes to replace people. And so just to develop that total exposure situation. And this allows for three things. First, gives governance bodies a live visibility. Second, gives funders and off-takers comfort that the system is under control. Third, creates a learning loop of pricing, eligibility rules, and operating procedures that can be refined and be made better over a period of time. So in short, the measurement is not an add-on, it is part of the guarantee. So how the guarantee works very quickly is a deposit first loss, the bounded cover, and then fast replacement. It's getting those three disciplines in properly. And so the guarantee is not a subsidy, it's a very time-limited bridge that helps people to move forward from there. So this is my final slide. And just to show you, we've modeled the thing out and what it looks like in 5 years' time. One hopes that you've got about 18,000 units that are in the process of being delivered, 36,000 construction jobs created, and about 54 billion Kenyan shillings of private capital basically mobilized. So for every guarantee exposure Kenyan shilling, it can unlock maybe 15 to 20 times that private construction finance. So I'm going to hand over now to Rob Hiff from Pngme. So Rob can talk to you about how we did the validation on the ground. Thank you very much.
Awesome. Thanks so much, Joe. Thank you, Sita, for hosting this webinar. My name's Rob, representing Pngme today, and excited to take you through some of what we were able to do with NACHU, the Placemakers team, and FSD to really start putting this system into action and some of the lessons we learned from that as well. So we at Pngme, we built a system and applied it to this affordable housing question by basically looking at what are the different forms of data that are available on a household today, both in formal systems, but both in the informal sector. And how do we aggregate that in the best way so that we can make an initial assessment of a household's affordability, and then also look at how this lines up with the tiered waitlist and system that Placemakers is really envisioning, to give different stakeholders in the ecosystem confidence. So we started with looking at NACHU, who obviously has access to so many of these cooperatives, and looking at digitizing their traditional onboarding. So creating the household profile, where are they looking, for housing, how many dependents do people have, and really just that base level knowledge that you need to know at the onset. We also, as a company, have developed a proprietary scoring model with alternative data. And that takes into consideration the digital profiles of a lot of the applicants. So this looks at mobile transactional data. We can then from that decipher what their digital income is through M-Pesa and other, uh, type of sources of information, and develop risk assessments that can be used to, especially because a lot of the wait list is in the informal sector, really look at that holistic profile. And then NACHU itself also has a great database and system internally of actually either hosting and collecting the initial deposits from households. So we looked at it as well an integration to being able to see what deposits might already exist from these cooperative members. Worth noting that some cooperative members save and cooperatives save with their own accounts, but NACHU does have access to some of those. So with this and unifying this, we were able to generate over 200 data points for both validating income, affordability, and different metrics that we looked at, but also then assessing against this criteria. So we've produced for the Placemakers team through this initiative, a live dashboard with a wait list and an index for the members we onboarded, the affordability ranking system that ranks this wait list, and then which is in the earlier stage, in which we'll show you a simple thought process of matching these applicants, is we also have the ability to then match them to housing units. I'll go on the next slide. So with the pilot, it was over a 12 to 16 week period. And what that included was a number of onboarding sessions for cooperative members. It was really essential for us to work in partnership with NACHU, building the trust with the cooperative leaders, but also members that are signing up to a system that requires data collection. It requires, assessment, and for them to give up some information. So that was really the focus of those sessions, to onboard and to build that trust. And it's great that NACHU has that trust relationship with its membership. And then through those sessions, we onboarded to the wait list 123 households. 18 of those through our assessment with the data sources that we collected, and how I'll describe how we did that assessment, we deemed as housing ready. And that system kind of rewards data completeness, but also looking at the specific variables themselves. I'll go to the next slide. And just to give an overview of the demographics of the waitlist that really align with the market level data that Stanley shared earlier. And we basically saw that 66% were women applicants. We had 61% married. We had a informal sector representation being quite high, with nearly 62% of applicants deemed to be in the informal sector, whereas 28 or so percent expressed that they were formally employed, which is what is really interesting, is also looking at applicants that have dual income and are both, maybe formally employed, but have other sources of income that need to be measured. And then the dependents that we had per household were about 3.2, which just showed the need for, when we go for the matching, the need for multi bedroom units for family dwellings. There's a few more stats I'll call out here. I think rental contribution was a really key insight for us, showing that over 70% of applicants were stating that they were going to be the sole contributors to household and rental payments, meaning that the need to actually decipher household income sometimes involves assessing two or more individuals. But what we saw was a really strong kind of independence on the rental contribution side. Go to the next slide. So we did a financial overview. Part of our data sources were self-reported data that we collected from the members themselves. And then some of the other data was from our assessment of their digital footprints. So we saw incomes for monthly income self-reportedly, ranging from the low end of the waitlist to 5,000 Kenyan shillings per month to the upper end of 300,000 Kenyan shillings, median being 30K Kenyan shillings. So you can see how that's kind of a reliable way to look at the income levels across the households we assessed. And then we also went to digitally verify this with the data that we were able to get on, on the digital footprint. Savings behavior, we saw that most people reported that they were able to save around 5,000 Kenyan shillings monthly. But we also saw some outliers with high digital balances. In this case, we're dealing with cooperatives, which include people that are holding deposits with their cooperative entities. So after doing these initial assessments, what's great with the tiering of the waitlist and intervention is we'd want to also look at what the balances of those deposits held with the cooperatives are to verify, how much might be available. We also ran a proprietary risk model on the waitlist with people had an average risk score, which is a Pngme produced product of 40%. This just shows actually the likelihood that someone might default on a 30-day loan obligation, but we thought it would be a good measurement to look at. And then further, 20% had reported some default with the cooperatives themselves. Most of the reasons were due to COVID, because a lot of these members had very long histories with their cooperatives. But just to look at these, these are three major buckets that we took into consideration: average monthly income, savings behavior, and risk and credit stability. So this is just a view kind of on the aggregate of the waitlist. I'll go to the next slide, please. So now on a granular basis, when you're looking on a household by household, behavior, data completeness, and what we're able to do with the first assessment is we built a affordability ranking and household assessment. This used about 183 potential data points that we were collecting on each household. And what it does is it assesses risk, income, cash flow behavior, and spending patterns, and then ranks this in a proportionally to how we would put importance to these variables. What's great about this is it gives a great foundation for assessing affordability, which isn't just income and cash, but it's on that financial resilience. And we can tweak this in ways that help represent people's applicants in the best way. I'll go to the next slide. And just a snapshot now from this waiting list system. We split people into 3 tiers. Tier 3 was just people that ranked second highest on the possible tiers to rank, and tier 3 represented 15%. So we deemed them as housing ready and really the top performers of the waitlist. The median income of this group was 50,000 Kenyan shillings. They had high transparency because we also measured how self-reported income and the income verification that we did, how those 2 indicators varied. And we basically want to say that this is a good group that can qualify for this system. Tier 2 was just the second highest of the wait list, was really categorized by the informal sector. Note that there's still many household applicants in this tier that with the collection of additional data, verification of additional data could definitely be put into tier 3 or upper tiers. And what this just looks at is kind of a snapshot of what a household profile card for this ranking would look like in these upper tiers. So the model is not perfect on the ranking system. We're taking in some feedback on which variables to consider more or less, but it does look holistically not just at income, deposits, and cash, but also looks at financial behavior, spending behaviors, cash flow month over month, and if any of there's any sort of digital red flags as well for an applicant. I'll go to the next slide. And I think this is where I pass it back to Joe to give an example of one of the housing projects that this waitlist could potentially be applied to.
So we have a project in Mololongo that if you look at the bottom right, it says the numbers of units. We, in our first phase, have 20 bed sit units, some 1 beds, 2 beds, 3 beds. And if you work it back to front, so we need, it's a total of, to fully occupied, we need 195 occupants here. So we need to get 196 qualified candidates ready or 195 candidates ready to fill up the first phase completely. But then there is an attrition because people are on various levels on the waiting list. So in terms of getting validated profiles in order to get to that 196 candidates, taking into account what Pngme has given us, is we need to get at least 986 validated profiles there. And there's also quite a heavy initial drop-off. So probably one would have to approach about 1,336 applicants to get to your 196 candidates. Now, the difference between the 196 candidates that are successful, that are moving forward, and maybe the 1,336 that now somewhere on that tiered system, is that we will work with the remaining people to make them more attractive and more ready. So the whole idea of the waiting list is there's a relationship and engagement to make those people, maybe get the data that they previously have not given, so that they're not data complete. We can get their profiles done correctly. Look at their saving maybe a slightly higher deposit ratio so that they can get advanced more to the front of the queue. But so on a real life project, this was a transition. And if you take the fact of the numbers of people sitting in a cooperative model and NACHU's membership at the moment, NACHU sits on a very big membership, so it is okay to say we want to bring many people onto the waiting list because we can offer them other financial incentives and products and services so that their interest is kept and that there's an incentive and a reason to be on the waiting list. And all of it becomes a journey towards housing, even if it's a long journey. Because at the moment, just being ignored, being 80% of the population simply ignored, is worse than being in a pipeline that might take a bit of time. Thank you.
Awesome. Thanks for that, Joe. And yeah, just wanted to be upfront with our, the lessons that we learned as well and how this is going to scale. Data completeness for these assessments is definitely critical. We know that there are a percentage of these households that have multiple contributors. So doing multi-household member assessments for income affordability is definitely essential in strengthening that profile for some. We did do a integration or pilot integration to cooperative data as well during this pilot. And that being a very valid and strong signal of, intention to buy and attention to put a deposit down is a really strong one we want to look at. Informal savings, and we want to also acknowledge, there's some cash-based societies, and basically providing the ability to look at multiple ways in which people can show informal income and informal savings to strengthen that, because it's really the nature of the market that we're operating in. And then I think a big, we had to do hybrid onboarding rather than just a purely digital intervention here to really build trust with the community. And just wanted to thank NACHU for opening up their community of cooperatives to do this pilot and trusting us, because it is in some instances it was a very a new thing or a new technology coming their way. So those are our lessons learned really from the pilot. And just to, I guess, piggyback off Joe's point, if I can see the next slide, is we only met with 29 cooperatives, onboarded 123 members just of that reach. And because we did a few training of the trainer models, we can access the total membership of those cooperatives, which is just under 1,000 members. And as we onboard more, and as this gets disseminated through that cooperative network, we can see a pretty clear path to national scale and market adoption, at least from the system side of things. But yeah, that's it for me. Thanks.
Joe, do you want to speak to this? It's just the last slide. That's it. It's just saying what we're going to go through.
So clearly we've now finished this extremely helpful opportunity. Sorry, can we just stabilize the slides, please? I don't know which slide I'm on. Thank you. What we want to try and do now in moving forward post this research phase is we already in the process of starting building this forward. So the various digital partners are all talking to one another, and we're busy forming that structure. We need to form the entity for the waiting list company, an entity. And what we want to try and do is carry on the momentum of onboarding at least 50,000 of NACHU's members through the cooperative networks. Now, in the longer term, we can open this up to non-cooperative groups of people, church groups, others as well. We're just working with the cooperatives at the moment because they are missioned to do this work and understand the work. And then we're hoping to be ready to issue the first guarantees at the very latest in Q1 in 2027.
Well, I want to thank all the presenters. This is it's very dense content, which I feel has been presented in a way that's easier to understand, but I'm sure people have questions. And I'd like to open the floor for questions. I think the best way to do that, because I haven't been following the chat, Larry, do you feel there are questions you can already start responding to?
There were some questions that were chatted, and I responded to those in text. But if you want to actually if they want to discuss those openly, that's fine. But
okay. Yeah, I don't know. Sorry, just with the way the presentation is, I'm struggling to see the questions. But can somebody guide me on how to do that best if there are questions that are unanswered? I wanted to give a few remarks as well on what really stood out to me and what placemakers are trying to do. The first thing is giving the household an aspiration, because they will choose a housing unit and start saving to that on a digital wallet. So there's transparency, and that they get rewarded for the savings. And then you take the pool of the members with the savings to help to unlock the financing. I think that's why this just felt like such a strong end-to-end solution, but it's where you walk the journey throughout. It's no magic. It's just saying we're lining things up. I think, to borrow Joe's words, this is coordination with transparency and governance to unlock finance. So if there are questions, if someone can just help me, I'm struggling to see them.
This one there, who are the prospective guarantors?
So Sita, I can help you out. So in the chat, we have some questions in the chat. I'll start with a question from Deborah Ab. Who are the prospective guarantors and how will the entities be funded?
Can I answer that? Do you want me to answer that, Sita?
Yes, please. Just let Lucy lead and you can answer.
Okay.
And you can introduce yourself, Larry, for people who may not know you.
So I'm Larry English. I'm a director of Placemakers, one of the directors. At the moment, the guarantee is really more a contingency fund. What we are talking to are insurers, and we're also talking to guarantors. We're in discussions with Maina, but there's no commitment on their side yet. This is really moving toward. We felt that because of when we look at like the example given, there's 196 units in the first in Malonga, it's the first phase. We expect that the probability of default. So because we're building a waitlist, occupancy risk is somewhat managed because we're actually able to reoccupy the building because we have a list. We're not just leaving it to the market. So that's one of the ways. So on our side, and then the percentage of default, we've calculated that. And so we're creating a contingency fund to guarantee our waitlist to the off-taker. And that period would be, so for a period of 2 to 3 years, we would actually take the occupancy risk and we would take the default risk during that period. And for that, we just need a contingency. We don't need a lot of money. Right now, the numbers aren't sufficient for some people to insure it. I see Richard Leftley on here. I'm great that you attended. But it's really just so in some ways we've got to prove the market, but we are talking to guarantors at the time. I've just mentioned one of them. But we're going to start with the contingency fund.
Thank you, Larry. I hope that is answered, Deborah. Another question from Deborah before we go to the Q&A section in the chat. There seems to be an overlap between the roles of Pngme and Empower. Is that right?
Pngme and?
Empower.
Well, Pngme is doing credit underwriting. So that means they're doing the credit checks using the data like they showed. Empower is mostly on the repayment side. That means so Empower is very housing orientated. Pngme is really sector agnostic. They're really about credit score, credit data. Empower is a system of collections which allows you to repay in amounts in irregular amounts or so the one is really a repayments platform and the other is actually a credit scoring. So Pngme are not involved in collecting money.
Yeah, if I may add to that, I think what we're finding is households cannot pay X every month. It's just not realistic for the target market we're looking at, and even formally employed. It's not realistic you're just going to be able to pay X every month and that will be affordable. So what we're trying to break it down, and even addressing one of the questions on deposits, we do feel the household needs to save to a deposit. We feel that 30% is a good level to give that buffer, that if you end up not being able to pay what you need to for any emergency that you didn't expect, etc., you can dip a bit into that buffer and build that buffer back. What MPOA does is just the back end for now. They may also attract offtake finance, but for now it's the back end, that if you paid, 2,000 this month and 1,000 next month, and nothing the month after, and you have annual goals of payment, not monthly goals, then on the back end, it can keep calculating how much have you paid based on your obligation. So that's really where Empower's role is seen right now. I hope that clarifies. So Pngme is to help to onboard, and Empower is to help to manage the savings, the digital wallets, etc., to give line of sight and transparency to when something is positioned as the rental part and when something is positioned as the rent-to-own part, which we feel must have flexibility. And Empower has proven this in Mozambique. They've worked with informal sector players. They've given them the flexibility to make annual milestone payments, but not monthly fixed payments. And they're showing that the households that they have worked with are able to make those annual milestone payments much better than the monthly fixed ones. And where they miss the payment, the deposit can be dipped into, or you need to replace the household. But there's transparency between what the household believes that they've built as equity and what the platform shows. So I wanted to give that clarity.
Thank you, Sita. We have some questions still coming in the chat, so I can start with a question from Jacinta. She has asked, which of these organizations can fund cooperatives to construct houses? And what are the requirements?
Maybe I can take that. Jacinta, nice to have you on this. We're really struggling with finding construction finance, the kind of finance you're looking for. You also help cooperatives. We've been to see your work and even researched it. Thank you on the bungalows being built in Nakuru. The cooperatives you're supporting also show that there's housing willingness and ability to pay, but we're lacking the construction finance. And this is how we're trying to unlock it, that if we give that long-term platform for households to start saving, that will prove that the offtake is de-risked and that will attract the construction finance. I'd really welcome Joe and Larry and anyone else, Stanley, if you want to add to that, but that's the crux of it. Jacinta, you're also sitting, you're also working with cooperatives who bought land. How do they unlock the financing?
Yeah, so that's...
And Lucy, if I could request you to put the blog that we did about the Nakuru cooperative with support from Hiff and CAF in the chat, that others can also have access to that.
Okay, we'll share that. Okay, so there's another question in the chat from Monica. What's the cost of the houses relative to the market rates of similar units? I think that should go to Larry or Joe.
Are you talking about what is the cost of all of this I just need to understand the question. The cost of
the houses, yeah, the houses being developed relative to the market rates of similar units.
Well, we're actually, Joe can add to the other costs, but at the moment it's actually before you start construction. That's the problem that we're trying to unlock here, is that people banks don't Normally, you verify the market through pre-sales. Yeah, we're trying to actually say there's a list of verified people. And up till now, we've used credit scoring, and that's fine, but that's just a score. No one's actually backing those tenants up. And so this is more a case of how does a bank provide finance to a developer to build rental units? That means not to sell them. There's no pre-sales involved. We can't sell them. So how do you verify that there is actually a demand that is willing to pay, an effective demand? And so this is more about unlocking the construction finance, unlocking equity too, unlocking offtake. But that decision has to be made before you even start construction. And at the moment, it's as Joe explained, the costs would so relative to it's not really relative. It's really just trying to actually unlock the finance in the first place. Sorry, I don't know, Joe, if you want to add to that.
I think I can't speak for other developers. I can speak for Placemakers, and our units. But certainly the units we produce are very competitive. Very, very competitive. It's lower than what a lot of other people are putting in the market. But we indicated a little bit on this slide some of the issues there. But it's very place dependent, and it's very much the typology dependent. If you have a 10-story, multi-story block in town center where the land is super expensive, your units are expensive. If you're 30 kilometers out of town and you're building, small single-rise units, your price is a lot cheaper. So there's not a single answer for this, but the government has certain kind of benchmarks for affordable housing. They change a lot and they're not strictly enforced, but we try to very much stay within those. And the assumption would be that there's a definition, it's not a fixed definition in Kenya for affordable housing. So it's not just what anybody thinks. There is a slow consensus agreement of what that means. Otherwise, it's commercial housing. So when we talk about affordable housing, we talk about things that fall within the definition, the current formal or informal definition of affordable housing in Kenya.
And I think we've shown some of the pricing that we're trying to achieve. So I hope the slide has come up, but it's showing that because the land costs, the finance costs, the approvals, etc., have to be paid for. So from the studio of 1 million, a studio of 15 to 25 square meters, to a 4-bedroom of about 4.85 million, a 40 to 80 square meter studio. Those are the prices, the delivery prices that Placemakers is aiming for this is really benchmarked on the Mililongo land, where they have good land already in an SPV and are trying to unlock the last stages of construction and offtake finance. So I hope that answers your question. We do feel prices are always in tension. There's always inflation. The current war is not going to help. But at the same time, we've never as a country explored economies of scale. So some of the costs that could come down are the pre-feasibility costs, the design costs, just all the coordination costs, because you've done it once, you want to replicate. But in summary, these are the pricing we're thinking of, which is affordable relative to what we see provided by private sector. There's no subsidy here as such. So private sector is delivering a bit higher than this because they're targeting a different income bracket. And typically private sector, what we see right now are installment sales. So it's pushing all the risk onto the buyer. What we're trying to do is shift that ecosystem where the buyers are paying, but they're paying in that digital wallet, right? And it's very, very transparent. And once the deposits are adequate, then they're moving into being allocated to a house, which will have been built by the time, so there's a whole process we still need to finesse. But the idea is in parallel, households are creating the deposits. Those deposits show proof to the financiers who can give the offtake finance that can unlock the construction finance, then the housing is built, the households move in, and then they're paying off the offtake on rent to own. That's kind of the big picture idea we want to unlock here. And we need to start with one project, which we're really hoping will be Malolongo very soon.
Thank you, Sita. So before we go back to the questions in the chat, we have some questions in the Q&A section. Question from Amolo. Can or will you say more about the chamas? E.g., will the groups work together to save or create lump sum deposits? This one's to be answered by Larry.
Yeah, Joe, do you want to take this question? I was just answering whilst you were presenting, so.
I think I've done a written. I've answered it in writing. Thank you. I refer to the written response. Thanks.
Okay.
Can everyone see that?
Go to the Q&A tab at the bottom there, and you'll see the question and the answers.
Okay, so we have another one from Isaac. For cooperative housing projects with limited upfront deposits from members, what strategies have proven most effective in using structured waitlists and guarantee frameworks to convincingly demonstrate demand to lenders? And how can small cooperatives replicate these approaches?
I can answer it. It's a good question. If you think of the two worlds that we sit in, the two worlds we sit in is either you have to save up all the money to go and build yourself a shack or a house or something informally, or you have to borrow from your family, or you have to go and put the floor in, save up some money, go to the window height, save up some money, etc., etc. This progressive housing thing. So the reality is there's no other journey towards it. It's a journey of expenditure and saving. And in the olden days, if you think back 10, 20 years ago, there was a lot of savings group, and the whole idea is they save together, and then when they've got enough money, they go build a house cash. Then there's the other group that says, okay, look, if you have a strong income, you can put a small deposit, 20%, 10, 20% deposit down, and we'll lend you the money, and it's called mortgaging, and you can pay for that. One person has to pay for everything, so effectively he's got 100% deposit. The other person has a 20% deposit. So why is there not a link up between that? So why can't I save up till I do a 40 or 50% deposit? So I'm on my way. I'm busy on my housing plan, right? And I'm saving up to get that, so that the residual money that's now left over becomes affordable for me monthly. It means that what I'm paying at the moment for renting a room or renting a bed or whatever else, that money now is sufficient to now finish off my housing journey. So the issue here is we expect the one half of 80% of the population, we expect them to save 100% of the money to go and build a house and self-build. The other lot, we expect them to only put down 20% deposit. Why can't we just fill the gap in the middle? And that gap should be filled in the middle. And this is where deposits are powerful. And it shouldn't be you're in the one bucket or you're in the other bucket. Can you not be in a continuous bucket? And we can see what we can do for you. But also, deposits are badly treated in this country, because you put your deposit in a bank, they hardly pay you interest on it. You lend it to your SACCO, they give you a small return every month on it. It's not even keeping up with inflation. So what if that money is invested, properly invested, and it makes, because if I come to you, Yitzhak, and I ask you to invest in one of our housing schemes, put some equity in, you're going to be wanting a return of 15 to 25% return. Why can't we make that possible for a 15 to 25% return on a micro investor? Hundreds, a million of small investors that can then earn that kind of money, which is much better than the 3 or 4% they're earning in their bank. So deposits and thinking through deposits are very powerful, and the waiting list makes that very much possible. So I think the journey has to start earlier, and the journey has to be more continuous, and has to be less siloed into whatever product somebody has concocted to go and foist onto somebody that wants simply a house in the end of the day.
Okay, we're actually out of time, but we're willing to stay on for a few minutes if people would like. Does anybody actually, I don't know if this answers the question, or does someone want to ask a question? Because the deposit is the big thing here. I know we can, I know it's tricky to envisage the deposits growing very fast, and we don't expect everyone to grow it at a specific volume. What the expectation is if there's a house they're aspiring to, just how they came together to buy the land, we're providing that structure for them to be able to save to that. So would anyone like to ask any questions? They could just unmute themselves.
Sita, we still have several questions in the chat.
Yeah.
If I can just go through them. So there's another question from Innocent Antoine. How do you secure the land before the house construction? I think that's what he means.
I can answer. I mean, this is not the issue that we don't working with cooperatives. You would have heard from Stanley earlier. Stanley said they have more than 300 hectares of land. So we are working with cooperatives that provide land. It may not be the same. The cooperative members that provide land and those that actually go on the waiting list may not be the same people. But we don't have a land problem. So securing the land is, as much as people say land is an issue, for us, we don't have a land problem. In terms of the suitability of land for particular income groups or price points, that might be an issue, but at the moment, that's not really something that we're finding that we're having to unlock. It does have problems, but it's not our biggest problem. Sita, I don't know if you want to talk to that.
No.
Thank you, Larry. I think that was very clear. So there's still that question from Amolo on Chamas, which was not responded to, on how...
Sorry, Lucy, we did respond to it. For some reason, our response has not yet gone through to the answered part of the...
okay.
Can
Well,
you just release the answer,
say it
please?
out, Joe? Please just give the answer so others can hear as well. Will the groups be saving together or creating lump sum deposits?
No, obviously saving together for your individual benefit, so no, you can't put a group deposit down for an individual's house. So no, you save together, but it's attributed individually. But the discipline of getting together and working together and the whole Pamoja thing should be at work here.
Can I add to that? There's also a curation function. That means the people on the waiting list are going to be at different tiers in terms of their ability to be able to occupy a house or to take on to sign an agreement. But that list also provides us, it helps us to work out what locations, what price points, how do people want to be grouped. So right now, and it is going to create some challenges because at the moment people pre-organize in a cooperative, but it would be that the different members may have different housing needs and different housing locations. Some cooperatives are related to an industry. But the waiting list allows us to help form the group out of individuals, not necessarily the group. Yeah, so it works a different way around. I hope that answers Amola's question.
Thank you for that answer, Larry and Joe. So we have several questions from Lawrence. I think I'll go with the first one. how will defaults be handled? What's the process leading to an eviction and tenant protection in place?
Well, Joe, do you want to talk to this? This is the specific of how
there's a
how
whole
the
process. There's a whole process. We the guarantee simply will not pay out to the off-taker or the landlord or whoever it is on a rent-to-own basis when there's a default, will not pay out if due process was not followed. So the process needs to be fair, it has to be transparent, it's prescribed. So the kind of formalizing that relationship is super important, because at the moment, I don't know what your experience in Kenya is, but it seems to be very random what people do when somebody defaults. So at least here it will force in a discipline, and the forced discipline would be that the landlord will have to notify the tenant or the occupant that they haven't paid. They need to do it quickly. So if the money was due on the 31st of the month, by the 2nd, they need to have given notice. They need to go and see the person. If by the 15th it's not resolved, go and see the person to see whether they're in hospital or they're dead or there's a problem, right? And follow it through. So there's a process to follow on that. And if the process isn't followed correctly, the guarantee will not pay out. And so there's also an incentive to train your off-taker landlords to be more procedural. So if you think of any kind of insurance, there's normally just a bit of proof required and documentation required. So this creates a formal way that is tested and checked. And if you feel that you have provided all the documentation, the landlord's at fault, could be the guarantee won't pay out because the landlord's at fault, it's not the tenant, So it's also a version of protection that way around. But, if you don't pay, you can't occupy. That's clear, right? You can't occupy a place that you're not prepared to pay for. It's theft. You can't do that.
Thank you, Joe. So for the second question from Lawrence, who holds the title deed during the tenant purchase phase? What's the thoughts on capital gains tax?
Okay, you're going way beyond our fireplace here in terms of getting into the taxation and all of those queries. But yeah, in short, because I want to stick to the knitting, stick to the topic. Here is the title deed is held by the off-taker. The occupant is his client, and the guarantee sits as a third party in that relationship. It's a rent-to-own system. Or a leasehold system or whatever. There are so many confusing words out there. But what we're saying is if you're not cash buying or you don't have a bank mortgage and you're not a classic renter where you're just renting the house forever and you got no aspirations to ever own any part of it, any other payment method in between, we call it rent-to-own. Right? It's a very broad definition. It's not the correct definition. It irritates purists like us sometimes, but it is what it is. So during that period, whoever is constituted to be the landlord in the contract owns the title deed. Till the last payment, till the last rent-to-own payment is finished, then the title deed is transferred over. And then, of course, there's a controversial thing around capital gains tax. Capital gains tax for affordable housing should be scrapped by law, but practically try to apply for that one and see how far you go, right?
So
if I could just add, there is some detailed consideration of capital gains tax, but probably we'd need to forward that to Lawrence. Yeah.
Okay, I just see we're 10 minutes over, so I'd like to suggest we can answer any other questions. We can set up calls with people. Please reach out to me. I'll pop my email in the chat if you don't have it. I would like to ask Stanley to give some closing remarks. This has been done under NACHU's umbrella. And for me, why I'm so excited about it is it's such a fragmented demand side. Even though they are organized in housing cooperatives, it's still fragmented. Now using both arms, the digital from Pngme is not the answer to everything. It's the relationships that NACHU owns and holds and has developed over years, and the cooperative members, the trust they have. So it's putting those two together, putting the supply and the demand on the same eyesight. So the households who are in the higher tiers and who can start raising the deposits, again, we feel between around 30% is actually what can work here because we're allowing flexible payments. So you've got something to aspire to, you've been matched to a household, you start saving, and that over time is what's going to move these 250,000 members under NACHU or the millions under other cooperatives slowly into the right housing projects for them. That's really the coordination that we're looking at, which has the governance in place. And we'll be following this with a very, very detailed blog. There's a good report going through all this. Some of the questions brought up are still theoretical answers in the report, like how will this work? We need to do it to make it work. But I think with everyone who's worked on it as a team, we feel it's lining up everything in one ecosystem, and we can unlock it through the first pilot. We really welcome partners to help us unlock the first pilot. What FSD funded is a small sliver of the work that needs to be done, but just demonstrating that this is what the potential is. So I'd like to please hand it to Stanley and ask him to close the webinar. And please do follow up with us for any more questions. Thank you so much.
So we'll take this opportunity to thank everyone for participating in this webinar. And maybe Sita, before I conclude, maybe I would also want to take the question that was asked by Lawrence on the issue of the capital gain tax. That if, for example, the land is owned by a cooperative, cooperative is in the business of real estate, that is their core business. And therefore, in that case, most of the cooperatives, the houses, the value chain that they have been able to add on the land, they have been able to escape the capital gain tax if it is your core business. So that is being handled that way. But now it brings an issue when it is a one-off transaction for an entity that is not in the real estate business. That is when the capital gain tax becomes a critical issue. But for cooperatives, the experience that we have seen, it's really not an issue. So thank you so much. I wish to take this opportunity to thank you all for your participation. Special thanks goes to FSD for having sponsored this research. And we are now inviting all our stakeholders to join us to be able to demonstrate, to be able to go to the next step, and be able now to verify, to move us the panel that Joe showed, so that we can be able to have the actual data of the members compared to the units that we are putting in place. So I wish to thank you all. I wish to thank our participants for your patience. I wish to thank Pngme. I wish to thank our partners, Placemakers, and all our cooperative members who have enabled this pilot process to take through. So thank you so much. I'm sure we'll be taking up, when we'll be taking up the next steps, we'll obviously be able to connect with each other. Thank you.
Okay, I apologize. There seems to be some difference in the timing. We had 4:30, but some people have written to me to say we're still fine. I do feel we should close the webinar because the expectation was 4:30, and we can definitely follow up. I'll put my email in the chat. But I also want to thank everyone. This is a very short 16-week pilot. Market facilitation takes longer than that. So, I do really feel very, very hopeful as having been in this ecosystem for so long, that this is a very disciplined way to do it. It's not promising, over leverage, etc. It's really trying to put people on the housing journey in a very disciplined way, matching them to projects, and in that way, unlocking finance. So the guaranteed pricing would really come from the strength of the savings records demonstrated. And that's what we all need to start working on as the next phase. We haven't started that yet. So with that, I want to thank the team. We are looking forward to issuing the blog and all the outputs and the webinar recording. Thank you, everyone.